Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to automated trading strategies for MetaTrader 5. Today we're taking a close look at an expert advisor called Fair Value Gap Runner. This strategy uses no traditional indicators at all. Instead, it reads raw candle geometry to spot a fair value gap, an untraded vacuum left behind by a fast move, and then it trades the continuation when price returns to fill that gap. By the end of this video, you'll understand exactly how it finds, confirms, and trades these gaps, and how every stop and target is calculated. Let's get started. So what exactly does Fair Value Gap Runner do? At its heart, this expert advisor trades a pure price action pattern known as a fair value gap, sometimes called an imbalance. A fair value gap forms when a single, powerful candle moves price so quickly that the market leaves a small range of prices that were never properly traded. Picture 3 candles in a row. If the high of the first candle never overlaps the low of the third candle, there is a vacuum of price between them. Markets have a strong tendency to revisit that vacuum to rebalance, and very often the original direction resumes once the gap has been tapped. This strategy was designed primarily for the euro versus the US dollar, or for gold against the dollar, on the 15-minute time frame. That said, the logic is built entirely from raw highs and lows, so it can be applied to any liquid symbol or time frame you prefer. There are no moving averages, no oscillators, and no lagging indicators anywhere in the code. The only average used is a simple mean candle range, calculated directly from recent highs and lows, and its only job is to scale the strategy's thresholds to the current level of volatility. In terms of trading style, this is a trend and momentum continuation strategy with a buy-the-dip flavor. Rather than chasing a breakout, it waits patiently for price to retrace back into a fresh gap, confirms that the candle holds the far edge of that gap, and then rides the expected continuation. It is best suited to traders who appreciate clean, rule-based price action and who are comfortable with a system that trades selectively, waiting for high-quality setups rather than forcing trades. Remember, everything here is for educational purposes only, and nothing in this video is financial advice. Let's walk through the exact logic, step by step. The expert advisor acts only once per newly closed candle, and it will hold just one position at a time. Before doing anything else, the strategy measures volatility by averaging the candle range over a recent look-back window. From that average, it derives 3 thresholds: a minimum impulse body size, a minimum gap size, and a small buffer used later for the stop. Next, the EA scans backwards through recent candles, looking for the most recent fresh gap. For a bullish gap, it needs 3 things. First, the high of the oldest candle in the trio must sit below the low of the newest candle, leaving an up vacuum between them. Second, the middle candle must be bullish, with a body large enough to count as a genuine thrust, at least the impulse factor multiplied by the average range. Third, the height of the gap itself must be meaningful, at least the minimum gap factor times the average range. The strategy then checks that the gap is still fresh. This means no earlier candle has already dipped into the gap, because we only want the very first tap, and no candle has closed below the gap space, which would have filled or invalidated it. If the gap survives all of these checks, the EA looks at the just closed candle. It must dip down into the gap and then close back above the base. In other words, price tested the vacuum, and buyers defended it. When that happens, the strategy signals a long entry at the market. The stop loss is placed just below the lower of the gap base or the tap candle's low, minus the volatility buffer. The take profit is set at a fixed reward-to-risk multiple of that stop distance. So if the stop is 20 pips away and the reward setting is 2, the target sits 40 pips in profit. The bearish case is a perfect mirror. The EA looks for a down vacuum where the low of the oldest candle sits above the high of the newest, a strong bearish impulse candle, and a meaningful gap size. It confirms the gap is fresh, waits for the just closed candle to rally into the gap and close back below the base, and then signals a short. Here the stop sits just above the gap, and the target is again a fixed multiple of the risk below the entry. Once a trade is open, the position simply runs to its stop or its target. Let's bring this to life on the chart in front of you. On the left, watch how a sharp bullish candle drives price higher so quickly that it leaves an untraded gap behind it. That shaded green band is the bullish fair value gap, the vacuum between the high of the first candle and the low of the third. Price then drifts back down and dips into that gap for the very first time. Crucially, the tap candle closes back above the base of the gap, telling us buyers stepped in to defend the level. That is the trigger. The expert advisor signals a buy entry right here, with the stop tucked just below the gap. From there, momentum resumes, price pushes higher, and the trade reaches its take-profit target as the reward-to-risk multiple is met. Now watch the right side of the chart for the mirror image. A powerful bearish candle slices downward, leaving a fresh gap above it, shown as the shaded red band. This is the bearish fair value gap. Price then rallies back up and taps into that red zone for the first time. But notice how the tap candle closes back below the base of the gap. Sellers have rejected the level. That rejection is the short trigger. The strategy signals a sell entry here, places its stop just above the gap, and rides the continuation lower until price reaches the take-profit target. So in both directions, the pattern is identical. A fast move creates a gap, price returns to fill it, the candle confirms by holding the far edge, and the EA trades the continuation. The gap zone itself is the entire signal. There is no oscillator and no moving average, just raw price geometry doing the work. And again, this illustration is for educational purposes only. Let's go through the settings you can adjust. The first is lots, which defaults to 0.10. This simply sets your fixed position size, and you should choose it to match your account size and your personal risk tolerance. Next is the impulse factor, defaulting to 1.2. This controls how strong the middle candle must be, measured as a multiple of the average candle range. Raise it and you demand bigger, more explosive thrusts, which gives fewer but potentially cleaner gaps. Lower it to accept gentler moves. The minimum gap factor defaults to 0.25. This sets how large the gap itself must be relative to average volatility. A higher value filters out tiny, insignificant gaps, while a lower value lets more setups through. Risk-reward defaults to 2.0. This is the ratio between your take-profit distance and your stop distance. At 2, the target is twice as far as the stop. Increasing it aims for larger winners, but typically lowers the hit rate. ZoneExpiry defaults to 12 and is measured in bars. It controls how many candles a gap remains valid before the strategy stops watching it. A fresh gap that is never tapped within this window is simply abandoned. Look-back range defaults to 20. This is the number of candles used to calculate the average range that scales every threshold. A longer look-back gives a smoother, slower-moving estimate of volatility. Finally, buffer fraction defaults to 0.2. This adds a small cushion below or above the gap when placing the stop, again scaled by volatility, to avoid being wicked out by noise. Always test changes on historical data before going live. And that brings us to the end of our deep dive into the Fair Value Gap Runner Expert Advisor. Today we explored what a fair value gap is, how this strategy detects a fresh gap from raw candle geometry, how it confirms a first tap before signaling a trade, and how it manages its stop loss and take profit. We also walked through every adjustable parameter and talked about how to run your own backtest. Remember, everything in this video is for educational purposes only and is not financial advice. If you found this useful, please hit the like button, leave a comment with any strategy you'd like me to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.